Dow Jones is sitting at 50,000, and everyone around you is saying the same thing. The government won't let it fall. AI has changed the game. This time it's different. In May 2007, people said the exact same words, word for word. 18 months later, the index had lost 53%. It's April 2026, and the same pattern is activating again right around May 1st. I want to show you what happened the last 3 times this played out and 3 specific things to watch for right now. Let's go back to 2007 because that's where the clearest signal appeared, and it's the one that everyone ignored. On April 25, 2007, the Dow closed above 13,000 points for the first time in history. CNBC analysts were openly laughing at people who warned of danger. The consensus was clear: the economy is too diversified to fall. But the data told a completely different story. On April 2nd, New Century Financial, the second largest mortgage lender in the country, filed for bankruptcy. Millions of Americans had stopped paying their mortgage. The housing market, which is the foundation of the entire US economy, had started to come apart. Then on April 27th, first quarter GDP came in at just 1.3% growth, the worst reading in 4 years. That same day, the Case-Shiller Home Price Index recorded the first annual decline in home prices in several decades, and by May 10th, foreclosures had risen 65% compared to the year before. On May 17th, Fed Chair Bernanke went on record and said, "The problems in the mortgage market are contained and don't threaten the broader economy." The Dow went even higher after that. By October 2007, the index had peaked at 14,164. An official recession began in December, and over the following 18 months, the Dow lost 53%. The data was there the whole time. People choose not to see it. Now let's look at where we are in April 2026, because 3 things stand out immediately. The first is oil. It's trading above $110, driven by the situation in the Strait of Hormuz. In 2007, oil was climbing toward $147, and when it got there, it acted like a coiled spring under the economy. The mechanism is identical. Expensive oil drains money that households and businesses need to service their debts. The second is the debt picture. The Fed rate right now is 3.50 to 3.75%. That sounds reasonable on its own, but here's the context that matters. In 2007, when the rate was 5.25%, the national debt was dramatically smaller. Today, even at lower rate, the pressure on the federal budget and on corporate profits is actually greater because the underlying debt has grown so much larger. It's a quiet pressure that builds invisibly until it doesn't. The third indicator is the yield curve. And this is the most important signal right now. From 2022 through the end of 2025, the United States experienced the longest yield curve inversion in recorded history. 27 months. An inversion means that short-term borrowing costs more than long-term borrowing, and in the US that indicator has preceded every single recession over the past 50 years without one exception. But here's what most people get wrong about it. The crisis doesn't happen while the curve is inverted. It happens after the curve returns to normal. The moment it normalizes, markets tend to relax. They read it as a sign that the danger has passed. And that's precisely when things fall apart. In 2007, the yield curve normalized in May and June. The collapse started in October. As of April 2026, the curve has just moved back into positive territory. 10-year treasuries are now trading above 4.3%. We are sitting inside the danger window. Historically, between 2 and 6 months after normalization is when things move. So what does this mean for May 2026? If this pattern follows the 2007 script, the Dow may actually keep climbing, but somewhere around May 1st, the financial market will surface a major bankruptcy, an emergency debt restructuring, serious problems in marine shipping insurance tied to the Gulf conflict, and the market will ignore it. That ignored signal is the thing to watch for. That's exactly what New Century Financial looked like in April 2007, 6 months before the prolonged decline began. Hold on to that idea because in 2010 things moved much faster. After 2008 crisis, markets spent 2 years recovering. By April 26, 2010, the Dow had reached 11,205, the strongest level since September 2008. The general feelings was that the worst was behind us. 10 days later, on May 6, a flash crash happened. In 36 minutes, the Dow dropped 998 points. Nearly $1 trillion in market value disappeared. Not over weeks or days, but in minutes. In 2007, you had roughly 6 months between the first signal and the beginning of the decline. In 2010, you had 10 days. Different timing, same entry point in the cycle. Now let's look at 2018 because that version of the pattern is arguably the most dangerous. Through all of April 2018, markets were being shaken by the trade war with China and rising Fed rates. It felt like the pressure was already at a peak. Then, between May 4th and May 18th, the Dow climbed from 23,900 to nearly 25,000. Investors concluded that the trade war threats were just negotiation noise. They started buying back in. It was a false signal. The market appeared to recover, and that appearance put people in at exactly the wrong moment. By the end of May, new tariffs hit steel and aluminum exports from Europe and Canada, and markets dropped again. The people who bought during that May rally took the loss. When you put all three cases side by side, the pattern becomes hard to ignore. In 2007, clear warning signals were dismissed and the decline began 6 months later. In 2010, the market peaked at the end of April and crashed 10 days afterward. In 2018, a false rally in May set a trap, and by the end of the month, it had collapsed. 3 completely different mechanisms, the same calendar window every time. And in 2026, all 3 underlying conditions are present at once: oil pressure, debt load, and the yield curve that just normalized. The Dow is at 50,000 with a narrative that sounds identical to May 2007. What you do with this depends entirely on your situation. If you're an active investor, May 2026 is not the moment for aggressive new positions. The thing to watch is whether any major financial announcement surfaces around May 1st and whether the market shrugs it off. Pay attention to VIX movement and short selling volume. If you see a new century moment that the market ignores, you already know what the pattern leads to. If you have a 401 key or retirement savings, this is a good time to understand exactly where your equity exposure is and what a 20 to 30% drawdown would actually mean for your timeline. One more thing, what comes after May? If May passes without a major move down, the next pressure points are August and October of 2026. January and February 2027 look like a more significant stress point, and based on the pattern I'm currently mapping, July and August 2027 appear to be the most challenging period ahead for the US economy, and particularly for the dollar. Keep in mind that in 2007 the decline lasted 18 months. What the pattern shows for the dollar over the next 5 years is a separate breakdown that I am preparing now. If that's something you want to see, write in the comments or drop your own question. I am building the next video around what you actually need to know. Subscribe because the next point in the cycle is already visible and it's closer than most people think.